Hello and welcome to Your Questions Answered. I'm Orla Tobin, a Senior Director at Goodbody Wealth Management, and I'm delighted as always to be joined by our Chief Economist Dermot O'Leary. Hey Dermot.
Hi Orla.
How are you doing?
I'm good.
So this is the third quarter. This is our third session of Your Questions Answered, and it's the third time you're in what you like to call the hot seat. How are you feeling?
I'm feeling good. Let's do this.
Good, okay. As for previous sessions, this is the quarterly video where we ask Dermot your most pressing questions on the economy, the market outlook and what to expect in the next quarter and beyond. We put 4 questions on LinkedIn and we asked you, our followers, to vote for the questions that you want answered the most, and I'm now going to ask Dermot our top 3. Alright, so first question, and actually this is an interesting one, and I think given the fact that there's been 10 successive rate hikes from the ECB in the last year, have interest rates peaked?
Yeah, and also a really important question because we have 2 very important interest rate decisions this week by the Federal Reserve and by the Bank of England. And as you say, followed that interest rate decision by the ECB last week. You know, first I'd say is that this has been a fairly fast interest rate hiking cycle. In fact, the fastest since the early 1980s. So central bankers have been caught off guard from the very start on this. It's harder to answer that question of whether we've reached a peak yet, because in all of those 3 different areas, the UK, the Euro area and the US, we see a situation where rates are in what would be described as a restrictive territory. And because we're into restrictive territory, the question is, how restrictive do rates need to be? And there's different opinions on that, and you'll see that in terms of views that have been expressed by the ECB last week. It wasn't a unanimous decision to raise interest rates last week. I think if you look at this week, there won't be unanimous decisions either way. I think in the US, let's take the US for instance first of all, and that decision will be made this Wednesday. And I think it's likely that the Fed will probably leave rates on hold. Okay. And I think for the US, I think it's more likely than not that rates have peaked. I don't think the Fed will say that and explicitly say that, but I think if you look at the evidence, we are seeing signs that wage inflation continues to fall and general inflation continues to fall as well. So I wouldn't say the job has quite been done just yet, but there's more signs and more evidence that the inflation genie is back in the bottle. Thus, doesn't need any more further interest rate hikes. With the Bank of England, it's different. I think there's another hike to come. I think that hike will come this week, and I think it's going to be very similar to message to what the ECB said last week, saying that look, rates are now in restrictive territory. We've done a lot over the last year and a half. We're not entirely sure that we've done enough, but more than likely we have done. The focus now really is going to come from not that particular question of have we reached the peak, but how long do we need to remain at that peak? So the ECB's message last week is, look, don't get too excited. We're saying rates have maybe peaked, but we're not going to bring rates down anytime soon. And I think a similar message is going to be coming from the Fed and the Bank of England this week, no matter what happens. So we'll need the evidence. It's all about the data watching. But certainly we're at or very, very close to the peak in interest rates now.
I love that analogy, the inflation genie in the bottle. It'd be great to keep it in there. Just bringing it back home, do you have any predictions for the budget 2024, Dermot?
Okay, so the budget is kind of framed around what we described in our latest health check as this embarrassment of riches that the country has at this moment. It's an envious position that Michael McGrath, the Minister for Finance, is in at this moment. A budget surplus of close to 10 billion, might not get to 10 billion this year because there was a bit of a weakness in corporation taxes in the month of August, but that's the kind of context that this budget is being set in. I would say, in August, the disappointment that we've seen in the corporate tax revenues in August actually is probably a little bit of a blessing in disguise for the Minister for Finance, because undoubtedly he has been having ministers knocking at his door looking for more money for their departments over the past couple of weeks and months. And I think that was a timely reminder that corporation taxes don't grow to the sky. They're volatile, they're very concentrated, and there's risks around it. So what do we know about the budget coming on October 10th? There's going to be a package of about $6.25 billion. There might be some extra one-offs that we've seen over the past couple of years in that, but I think there's less need for those one-offs this time around. So for instance, if you go back to last year, remember the spike in energy prices was happening, households and businesses were struggling, so there was a need for these extra supports. We got the credits, for example, electricity credits.
Do you see that again, Dermot, just given, I suppose, interest rates being so high? And
I think they'll be more targeted this time around. That's the message that's going to come from this. There's going to be targeted supports. Even so, the big issue, as we just talked about in the first question, was obviously interest rates and mortgage interest rates. So I think we will see some very targeted supports in terms of mortgage interest support, probably through the welfare system. But in terms of what this $6.25 billion is going to be used for, there has been criticism from the Fiscal Advisory Council about that amount of money being too much, because we have this inflationary environment that we have to deal with now. Personally, I think it's a very minor overshoot of the government's targets, and I'd say also in relation to this, the focus has been, or will be, going into next year, in relation to increases on the capital spending side. So there's a faster rate of increase in the capital spending as opposed to the current spending side. And I think that's important because literally Ireland is, as I say, full at the moment. It needs this infrastructure. So the supports, the amounts of money spent will just basically be going to keep up with inflation in relation to public sector wage increases, welfare increases, some targeted supports, as we mentioned, and obviously the capital spending element. The more important thing for me, looking at this budget on October 10th, is not so much the minutiae of the details of that. There will be some minor surprises probably that will come from it, but more so what the Minister wants to do with this embarrassment of riches. So it's the policy statement in relation to one, a sovereign wealth fund, which has been mentioned since April. So how much of the extra funds coming from corporation tax will go into the sovereign wealth fund? And secondly, how do we maintain, going back to this point about capital spending and putting this infrastructure in, how much of the funds will go towards what we call the capital stabilisation fund? So the context of this is Ireland has a boom-bust episodes in relation to capital spending. We have this opportunity as a country with this massive amount of corporation tax coming in to put it into a fund to stabilise capital spending. And I think those two important messages, they're kind of key for me on October 10th, rather than the details of the $6.25 billion.
Very good, thanks, Dermot. They were the main two questions, I suppose, that were voted on, but there was, if you wouldn't mind just commenting, I suppose briefly even on, do you think there's a hard landing likely in China?
Okay, brief comment on hard landing on China. Look, China has got a lot of attention over the summer months in particular, so it is a key kind of issue for financial markets. There's no doubt that China is going through a fairly severe property correction. Now, there's been risks about this in the past, given what we've seen in terms of increase in values, etc. What we have seen is a collapse in property transactions, but not so much a collapse in property values. Property values are down 5 to 10%. I think it's deliberate by the Chinese authorities that are not coming in a big way to actually stall this collapse in transactions, because the view is that if you do something now to property even more, the problem will actually get bigger into the future. So it's their policy now to let it deflate. We have seen some reductions in interest rates, but the overall reaction has been actually quite minor relative to what we've seen before. In relation to a hard landing, what I'd say is that there is plenty of resources that the Chinese can use and mobilise if they actually want to do that. There's a massive amount of private savings in China, for instance. So I think that we will see further problems in terms of slowdown in China. I think that has global implications for things like commodity prices. But as I said, if they have the will, they definitely have the resources to put in some stimulus to
prevent a hard landing. Okay, brilliant. Thanks, Dermot. Thank you for answering the questions today. Insightful as always. Thank you for joining us. If you have any more queries, please don't hesitate to contact your portfolio manager. You can also email us at goodbody@goodbody.ie. Thanks for joining myself and Dermot, and we'll see you in Q4.